Hello, connoisseurs of smart trading, and that is exactly how option trading should be called. Because I've been trading options for over 20 years, and I have been developing different educational programs even on the basis of the Moscow Stock Exchange School and so on. Actually, in this video, I want to stop on 3 main mistakes in option trading, where the majority lose money. Not even 3, but 3+, so to speak. Make sure you watch the video to the end, because at the end there will also be a very important point related to option trading, without knowing which you will definitely have problems making profits with option trading. Okay, here we go. But first, be sure to subscribe to our unique options trading channel. We're going to have a lot of useful information, and right now it's already contained here. Give us a like if you like this video and if it is useful to you. And it will definitely be useful, because these are the most common mistakes in options trading, which I've been observing for over 10 years. So, the number 1 mistake all novice option traders make is that they get into the business of buying so-called stripped options, or naked options. Here's a simple example. Here we have Bitcoin. Here is the expectation that the price will go up. For example, the trader buys some options. Let's say call of strike 27 options. And look what we have. The trader assumes he has a scenario that these options will go up in value and bring him a significant profit, because Bitcoin will go up in value. Accordingly, these call options will rise in value and bring him a significant profit. As a rule, such expectations are never met. And even if they are justified, his profit is insignificant. Because let's assume that the price is really going to rise a little. But due to the fact that he bought 2 expensive options for cash, they can be expired a little with money, but still not enough to make a profit, because of the time award of those options. And the downfall is a profit. Basically, everyone starts out by buying so-called stripped or naked options. It's the most inefficient way, and they're more likely to lose their money. Yes, they might get lucky at some moment of the time, and indeed the price of the option will shoot up. But most probably they buy such options once, they buy them a second time, once they buy them a third time, and after losing some money on it, the trader just stops doing it. He just realizes that it's foolish to buy these stripped options. Therefore, there are strategies, such as vertical spreads and so on, which use a combination of options, buy and sell. So please see my other options are easy course videos about this. Everything else is basically unimportant. Stripped options near cash are expensive options, and they tend to lead to a failure. Next point. Suppose that after realizing a little bit that buying options is a bad idea, and trader, after reading a couple of books, comes to the conclusion that he should sell the options, because most likely some event will not happen. He says okay and proceeds to sell options. Let's say options put of strike 23 out of the money options. We call them delta 019. The 19th delta is kind of options almost on the edge, so to speak. So, he sold options, or let's say even not just bought and sold put options, but also sold call options, for example. And then expects nothing to happen. Look at this stranglehold. He sold the call of 27th strike and the put of 23rd strike. He expects nothing to happen, sits back and waits for him to get all the time award. Look how smart he is. He have read 2 books and expects the market to pay him for it now. Not a chance, my friends. The point is that options award is directly related to volatility, and options are calculated based on market volatility. And the implication is that options can go in the money. And the implication is that such price movement is quite possible. What happens? The trader sits, does nothing, and waits to receive this cap, wants to earn his $500. He thinks that this is a super strategy, but no, the price moves. Let's say the price goes up or down in that area. Give me a second. In the 22,500 area. That's where the money comes in. And that's already a significant loss. And then he takes it and redeems it, thus fixing the loss. Such things also happen. On the rise, he fixes the loss by calls, or does not fix any loss at all. It simply grows and grows. In short, mistake number 2. Selling naked options without delta hedging, without insurance. No rollover, no delta hedging, just at random, hoping that the price won't go over that cap. And it does, and the trader is not prepared for that. How could that be, he thinks probably. He thinks probably the price will come back, but it doesn't. It always keeps falling or growing aggressively enough. The loss increases, and the trader fixes this loss by buying back everything that was sold. The price returns to the market, and that's it. But the loss has already been fixed. This is the error number 2. Let me put it more specifically. Selling options without delta hedging is the most common mistake to expect that some price event will not happen. It does happen, and it doesn't matter. Maybe even the first time you sold such a strangle, or just call, or just put, and really got that profit from the temporary decay of the award of those options. The second time you sold it, you got it. The third time you sold it, the price moved, and the loss received by this trader is so significant that it exceeds the profit received from the previous sales. And it can even bring the trading account to zero. Therefore, delta hedging is mandatory when selling options. Absolutely. Even if you are managing an option strategy through option rolls, you should still have a delta hedger on hand to manage market risk. This is not some book strategy, some kind of fairy tale. This is a real market, and prices move very significantly here. There can be very significant price movements. If you're not prepared for that, don't sell any options at all, because that's incredible risk, especially with options on the edges, deep out of the money. Next, mistake number 3. The trader realizes that buying option is going bad. He loses money. Selling options without a delta hedge is also a bad idea. Again, he loses money. But what does he do? He surfs all sorts of chat rooms. He consults some option gurus. He gets some clever strategies, sophisticated and complex option strategies. Let us have a look at an example of such strategy. For example, this variant of strategy, a simple strategy produces something similar, only more... For example, this strategy, there are actually 2 ratio spreads. The first one with calls and the second is with puts, and so on. Complex strategies where the person, the trader, is trying to view this strategy as a universal one. I personally always recommend you to consider any complex strategy through spreads. Take it apart by spreads. If we take this strategy, we simply take it apart into 2 spreads. Here we have one ratio spread on calls and another ratio spread on puts. Each ratio spread is considered separately, and we understand what happens to it, what is its P&L, and whether it makes sense to hold it or close it, and so on. When a trader takes some complicated strategy and considers it in its entirety, he thinks it is a panacea for earning money. And this is a very common misconception. To complicate an option strategy when a person doesn't understand how it works, how this strategy functions. It seems to him that the more complicated it is, the higher the probability of profit. Nothing of the sort. That's not how it works. On the contrary, the simpler the strategy, the clearer the strategy is to you. Then it will be easier. The simplest, the most effective strategies are those that work. Buy cheap, sell expensive, and vice versa. In fact, that's how it is. And in spread, it is also like this. And it is clear and understandable to you that this option gave me a profit, and this one gave me a loss. And with this general strategy, it's important to understand the inclusion of the volatility curve. It has an additional effect. And as a result of such strategy, the trader does not understand why he got this loss. For him, the obtained loss is not a payment for the lesson to the market. It is just the loss of money. He just lost money. It's unclear why. It is easier just to play the lottery or something like that. Without making any conclusions, he doesn't develop in any way. His trading strategies don't improve, or his complicated calendar strategies, not a simple calendar spread, which in itself is already strategically complex. There you have two actual volatility curves at once, and you trade on a spread volatility of different series. And there are even more complicated strategies with multiple strikes, after which the trader scratches his head and thinks, how is that? Why haven't I earned anything? Why do I have losses here? And that's why everything must be broken down into simple strategies. Minimal, simple strategies. Any complex strategy can be broken down into spreads, and each spread can be analyzed separately in order to see what it will give you. That's why mistake number 3 is using complex options trading strategies where the trader doesn't understand how to make money. What are the advantages of his strategy? Next, here is what I want to talk about. I want to inform you about an important thing in options trading. Because options are high margin, high risk instruments for trading. Where there is a high risk, there are high profits. On the size of margin requirements, there is a common problem, a very common problem, is that the trader uses his funds as much as possible under margin requirements. That is, the size of GM. He loads his trading account with maximal amount of margin, and in this case, any price movement, and as a result, he has no room for maneuver. Any price movement leads to margin call, and this has its own requirements. It is necessary to deposit funds to the trading account, and if he doesn't comply with these requirements, there is a procedure of forced closing of part of the position. For example, on the ae platform, there is no liquidation. But on Binance's, if you have violated the margin requirements, they just liquidate the position's account and you have zero on your account. This is a robbery strategy, frankly, this liquidation. But here is different. It's just reducing the size of the position to the amount of margin requirements that are sufficient, so that there are enough margin funds to meet the necessary requirements, so that the money becomes more than GM. In this situation, please be sure to pay attention to the fact that you do not need to load your trading account at 100% of the requirements. Use 20, 30, 50% maximum, because that's enough for you to have some options to maneuver, some room to maneuver, so that you can do something with your option strategy. You can control it, you can hedge it, because if you have a margin requirement that's higher than what you have in your account, then you can't automatically put out orders to open positions. You might not be able to place orders for hedging either, delta hedging with futures and so on. All of this leads to risk. Naturally, a forced reduction of your positions by the platform's risk managers is worse than you managing your position yourself with a higher commission. Buy some hedge options. Reduce the risks yourself. So once again, I draw your attention. Take seriously regardless of account size. Get used to the fact that margin requirements should not be more than 50 or 60% of your trading deposit. So, here are the basic mistakes I wanted to tell you about. Please be careful, don't lose out on trading options, but rather make money. Have a great, smart option trading. I wish you the right trend and volatility. Thank you all, give me a like if you liked the video, write your questions in the comments, what option trading requirements you find interesting. Goodbye and trade successfully!